Yo, what's up, everyone? Welcome to episode 41 of Great Quarter Guys, a show where we break down the walls in between freight, finance, and tech. I've got my friend here, Kevin Hill, with me. I've also got Seth Holm on the line. We have a fun show today. This pains me to say, but I'm going to call this the Alvin Kamara episode. Number 41. I feel like he's the best number 41 in all of sports right now. I'm a diehard, lifelong Vanderbilt fan. So to call this any type of ex-Tennessee player number episode kind of hurts me. But Alvin Kamara, he's a baller. So we'll go with the Alvin Kamara episode today. We're going to talk about, we've actually got a few topics that I've been meaning to hit the last few weeks, and we just run out of time because I'm terrible at packing too much into one episode. So we're going to talk about, finally going to get to Pershing's blank check company. This is Bill Ackman's new SPAC that they're going to go after mature unicorns. We're going to talk about where we think he might go with that. He's got a perfect track record with restaurants. Maybe he continues that trend. We'll hear from Seth and Kevin on that in a moment. But then we're going to talk about some department store bankruptcies. There's been, I think, 16 so far in 2020, a lot of big names. The latest one being a Steinmart back on August 12th. So we'll talk about where we think the other ones may go, if there's going to be any more major dominoes to fall throughout the end of the year. And then we've got a fun conversation, really focused on the economy. We're going to talk about whether we think we're going in the course of inflation or deflation. I think there's some big differences in our belief here. Kevin is on the deflationary environment side of things. So we'll get to those right after our You Care or Nah segment. The first one, we'll start it off the top. I'm going to send it to you first, Seth. This is the U.S. Homebuilder Sentiment Index just hit a 35-year high, or is actually tied for a 35-year high when the data came out, I think, just yesterday. What do you think, Seth? You care or not about the U.S. Homebuilder Sentiment Index being so high?
I do. I think you have to care. I think a house is, every U.S. consumer, most U.S. consumers' primary asset by far. It's their life savings and it's all their net worth. So it's good to see, and it positively impacts consumer confidence. Even though we got a bad consumer confidence number, I think today, rising house prices, as long as they don't overshoot like they did in 2006, they help out consumer sentiment and net worth. So yeah, I do care.
Kevin, you care or not about the Home Builder Sentiment Index?
I don't. Not because home builders aren't important, homes aren't important, and Seth is exactly right that it's most people's biggest assets. Show me 2 or 3 months of printing that big of a number, and then I'll start caring. I think the home builders might be a little bit too optimistic, which happens from time to time. So I personally don't believe it's really that high.
I disagree with you in thinking that they're a little too optimistic here. I think on Seth's point about the consumer confidence, that number was a bit too high last month. I think we kind of rushed to judgment and got a little bit overexcited about the retail sector. But I do definitely care about the Home Builder Sentiment Index. I talked about this on FreightWaves Now today with Anthony, if anyone wants to take a look at it. There's a lot of tailwinds right now. You have really low interest rates. You have a good supply of labor, which was an issue pre-COVID. The only headwind here is something I wanted to bring up to you guys, whether you care or not about this one. And Seth, what do you think about lumber prices? Have you been paying attention at all? They've doubled since the beginning of 2020. You care about this or not?
No, I don't care. But I have been following it. I got to say it with an H, right? Nah.
No, you say it however you want.
Nah.
I say no. I'm from Memphis. So, I don't really care. But, with lumber prices, that is a headwind eventually to housing because that's a primary input. And the other thing that pops into my head is there's this company that I used to own called Trex. They make these synthetic outdoor decks. It's probably a good thing for them with the booming house market. I do think that eventually if it becomes too expensive to build a house, that will become a headwind. That's the only aspect I care about there.
Yeah, I do too. I think it's this big. It's doubled. There's a lot of confidence out there. I think there are a lot of tailwinds for home builders to be optimistic about, but I'm not sure if those won't get pulled out from under their feet at a certain time.
I did care about this until I spoke to Anthony about it, our chief economist here at FreightWaves. He says that he believes most of this is just from the shutdown of the mills in April and May. They were not expecting this influx of demand, so they went ahead and shut down operations pretty early and kind of caused a supply panic here. The only thing I do want to say that I am a little bit worried about here is that Canada is also having the same type of new interest in home building. In July, they had a record high for new home sales, which has spurred on a boon of housing starts there. So that's our biggest competition for wood. They're our biggest we import a lot of wood from there. So there's just more competition. So something to pay attention to. I think once those factories get back online, we're going to see those numbers come down a little bit. But in any case, they've doubled since the beginning of 2020. So a big deal. All right, number 3. Exxon Mobil, who has been a part of the Dow in some form since 1928, since its beginning. Its tenure as the longest-serving component is now over. They have been pulled out and replaced by Salesforce. Kevin, you care or not?
I do, just for the reason because I remember, and I had to look it up, the year 2011. I remembered this because it was huge news because Apple is about to surpass Exxon Mobil as being the most valuable company on the stock exchange. This is what we have 9 years later. Apple is sitting today at $2.12 trillion market cap. Exxon Mobil, $172 billion. So it's like worth 5%, right? If my math is right. 5% of what Apple is today a decade later.
Yeah.
About 10%.
10, yeah.
So it's amazing how, it seems like a long time, 10 years, but it goes by just like that. And the roles have just reversed.
No doubt, tech has taken over. That's my big takeaway here. That's why I care about this. It's just another stamp and another continuing of this trend of tech taking over the old industries of the U.S. Seth, you care about this one or no?
No, I don't. I can't believe Kevin is from Oklahoma. He's got to care about this. But no, I just think it's a changing of the guard. And Exxon, I saw that they cut their employees' 401k matches to maintain the dividend. So I don't really feel that sorry for Exxon. Got to go at some time.
That's a fair point. All right, last one I got for you fellas is a very hyped IPO that we've been hearing about for the last couple months. We haven't talked about it here on this show yet, but this is a cloud service provider called Snowflake. I won't go too deep into what they do, but they just released their S1 yesterday, and there's some ridiculous numbers on it. Revenue through the first half of 2020 doubled from the first half of 2019. Gross profit tripled for the same period, and their net losses have narrowed a little bit. They're still losing quite a bit of money. I think $180 billion for the first half of the year, but there's nothing new about that. All of these tech companies are losing. Seth, we'll start with you, man. You care or not about this Snowflake filing for IPO?
I do care. I think that this single IPO, along with Palantir, has the ability to sort of reignite the software rally. This company, given the growth, and I think the gross profit tripled on top of like 150% revenue growth. And then their net dollar-based net retention is like 160%, and their average client's like 170K. Just off the chart metrics. This thing could be like 50 times revenue. I know I won't get a chance to buy it, so that won't be great. But I do think that it'll be good for the software sector and sentiment and momentum in that sector.
Kevin?
I agree 100% with Seth. It's a bellwether to see about all the other software IPOs. It is ridiculous numbers. So they doubled sales with the same amount of losses, basically. Right. Within that same band, which is amazing. I just hope all the other software companies in line have as good as metrics as Snowflake.
Yeah, likely not. I care about this one. I want to point out something that Seth just said. Seth said that net dollar retention, for any of you non-finance nerds, basically that means for if they didn't gain any more customers, their revenues grew 160% year over year, and they also did gain 600 new customers. So that's the type of growth we're talking about. They're upselling out of the booty. So that's fun. Let's move on to Pershings. Finally, we're getting to this topic I've been wanting to for weeks now. As we discussed a few weeks ago, Bill Ackman and Pershing Square, they raised $4 billion in a blank check company. This isn't new. We've seen a ton of them this year, especially in the freight tech world. We actually just got another one today or yesterday, Lumina or Luminar. Mm-hmm. Either way, it's one of Peter Thiel's investment companies. They are going to go public through a SPAC, $3.4 billion. We heard another one last week, which was Canoe, another autonomous vehicle company. There's literally every week there's one coming out. We don't think Ackman's going to go there with this SPAC. Obviously, that's not typically his ballpark. But he is saying that he's going to target mature unicorns, and these are, of course, private companies with valuations over $1 billion. I think it would just be fun to discuss where do we think Bill is going to go with this? What do you think he's eyeing it? What makes the most sense for you, Seth?
Yeah, so by the way, I'm going to go ahead and plug our paper here. We're doing a SPAC paper and passport research on Friday, so look out for that one for any of those passport research subscribers out there, where we'll have a lot more on SPACs in general. I think with Ackman, he's raising $4 billion, but then he's going to contribute another $3 billion from Pershing Square funds, and then you can lever it up. So, a lot of areas he could go. He's going to go big. And, if you look at Ackman's history, just to kind of invert this, his specialty is consumer industrials and maybe kind of consumer facing technology. So those would be my three sectors where you could kind of narrow it down to. I'd seen the media had kind of speculated on two names. They were throwing around Bloomberg and Palantir, although Palantir just, I think, released their S1 today and is going to do a direct listing, so you can probably count that one off. Bloomberg is a fantastic business, maybe more pricing power than any business I've ever seen, and it's ridiculously expensive. That kind of makes sense. That the name that I came up with, given his history and success with restaurants like QSR and Chipotle, is Chick-fil-A. I think is where I would go after, but I'm not sure that the Cathy family would want to let him in, especially given his reputation for sometimes butting heads, and they would want to maintain control. But that one is one of the most amazing companies out there, and probably fits in that size bucket and his specialty of what he looks at.
Yeah, do you think Bloomberg is a little too big? What are they valued at now? I have no idea. 80,
I think it's like
100
billion. So we kind of talked about the math. If you throw in $7 billion in equity, but you lever it up 4 or 5 times, it might be just a little bit too big. I don't know, because you said he wants a controlling stake, right? So, I don't know, but that's the one I've seen out in the media.
Kevin, give us your thoughts.
I think both of those points are really good from Seth. Bloomberg and Chick-fil-A are amazing companies, and they're probably overpriced. To get your hands on either one of them would take such a premium, because they are such fantastic companies that I don't think Ackman will go after it. I'm going through the 2019 Forbes America's Largest Private Companies, and it's almost like picking a name out of a hat. You do want to consumer-facing type of situations, and one name that caught my eye, and this is completely random, is Bass Pro Shops. So Bass Pro Shops bought Cabela's, their main rival, a few years ago, and they own this very large niche of outdoor type of superstores, experience shopping. So I think that's very interesting, and probably has enough cash and enough leverage left over to maybe do a couple bolt-ons. Bring in some, nichier players out of that. So it's interesting, but it's totally random guess.
Yeah, I mean, there's no wrong answer here, right? Because Bill Ackman's a bit of a wild fella anyway. He does a lot of things that people can't explain, but. Yeah, I think Bloomberg's a little bit too expensive. I think it's a little too big. Chick-fil-A is probably the best run company in America. I don't think I'm with Seth on the fact that the family that runs them probably is not going to let Bill in. So here's my ideas. My initial thought when we wanted to talk about this about 6 weeks ago was Airbnb. I thought that's in the wheelhouse now that the valuation has come down, but it doesn't seem like that's going to be available for them. Airbnb's moving forward with their IPO later on this year. And then I've got a couple that made a little bit of sense for me. If I was looking at food, I think if he wanted to replicate what he did in 2011, doing a SPAC with Burger King, taking them public, I thought Panda Express might sound like a decent idea. A big company, been around since the 70s, a lot of stores, strong brand. Mm-hmm. But then another two I came up with was Epic Games. So this is the people that make Fortnite. They've been around for a long time, since the early 90s. They've gotten a lot of media attention recently because of their battle with Apple. Yep. But it's a company that's grown massively. They have they're only owned, I think 25 or 20% of it's owned by Tencent, but they've got shares to give away that they'd be willing to do. And there's been rumor that they might go public soon. So I think that one kind of makes sense. And then the last one is Bose, the speaker company, Bose, B-O-S-E. And I think this because of the way that Sonos has been running up this year. They've had a very strong public interest since their IPO. I think Bose makes a lot of sense. Again, just really strong brands that he could get onto. Seth, do you have any final thoughts on this before we move on to department stores?
Well, I would just say one thing. Bill Ackman has a very long and storied history with the railroads. So he made huge home runs on a couple railroad investments, and was very close and actually installed the late great Hunter Harrison in a lot of this PSR stuff. So I think you can probably count the number of transportation companies that are over 40 billion on one hand, or maybe two. So, but that's something to be mindful of. So he does know the transportation space. Maybe, and with valuations a little beat up, in COVID, maybe he swoops in and buys something in the transportation space.
I'd welcome him back with open arms.
Definitely.
How about you?
I would too. I think it'd be a great buy if you can find the right acquisition.
Well, let's talk about department store bankruptcies a little bit here. We have had a lot of them this year. Like I said, there's been 26. I'll just name a couple for you. The latest one was Steinmart, but huge ones like Lord & Taylor, Brooks Brothers, Lucky Brand, GNC even, Pier 1, True Religion, JCPenney's, Neiman Marcus, J. Crew. I mean, the list goes on and on and on. We're probably going to see some more this year. That's what we're here to talk about. Seth, can you give me? Okay, let's go long short. Do you think long short? Do we see another major department store or retailer, big box store bankruptcy before the end of the year? And if long, give me an example of what you think might happen.
Well, I do have one question because I think major. And I come down to 4 or 5 guys. So
okay.
If you're talking about Nordstrom and Macy's, which are the only 2 left, I don't think either of those go make bankrupt. Nordstrom is family run and very conservatively and well run. And then Macy's did a big capital raise, I think, back in March. So I think those 2 are off the table and are going to be fine. They're not going to do great, but they'll be fine. When it comes down to the lower end, the Dillards and the Belks and the those type, and I don't think Kohl's, if you count Kohl's as a department store, will go bankrupt. I think it's going to be more of those sort of also ran sort of $1 billion or less market caps that some of the ones you missed. I would definitely go long if you're talking about sort of a subscale regional department store player. I'll go long.
Seth, I have one company in particular that's been on the top of my mind, and it's not because it's really just because I just went into one of their stores for the first time in maybe 10 years, and it was a Bed Bath & Beyond, and the store hasn't changed one bit, and I've read that they've had kind of struggles on e-commerce, but you seem to like Bed Bath & Beyond. At least you liked it when it was beaten down quite a bit back in March. What do you think about Bed Bath & Beyond? Any chance? They got a decent balance sheet, but any chance of them running into Chapter 11 before the end of the year?
I don't think so. They actually put in place a new CEO from Target who and you saw how well Target did. If you looked at their earnings report, I think you guys talked about this on the latest podcast last week that I listened to. Target is a well-oiled machine and is doing fantastic. And so I think the guy that they brought in knows what he's doing. You got some real sort of painful changes that'll need to take time. He's trying to rationalize the store fleet. And they don't sell anything that's not with that 20% off coupon, but I think Bed Bath will survive. I'm not as bullish on it after, I think it's doubled or tripled off the bottom, but I think it'll be fine.
All right, Kevin, what you got?
I was kind of high about Ackman buying Bass Pro and stuff, and now I'm going to basically trash a little bit of in-store shopping and retailers, and I think the department stores will be fine, but I do think the more specialized mall stores is what I would call them. The J. Crews, the Pier 1, maybe the home stores that have been just languishing for forever, or the Steinmarts that were decimated by TJ Maxx and Ross stores. We're going to see quite a few more. I think we're going to see across the line of those specialty, let's call them specialty retailers.
That's the term. Yeah.
That is the term. Okay. So I think, True Religion, things that go in and out of fashion or
yeah,
trends.
That shit's never been in fashion.
Yeah, I know, right? Things like that. Items like that. I think there's a lot of private equity jumped in. They're leveraged. We're going to see a lot of bankruptcies.
Yeah, I'm with you on the specialty retailers. Go ahead, Seth.
No, I was just, I think we always talk about how private equity doesn't have a great history with asset-based trucking companies. I think that's also true when you lever up a mall-based specialty retailer into the biggest downturn in 100 years, you're going to have some more bankruptcies.
Yeah, I think one of those specialty retailers that I've gotten written down that I've been thinking about is GNC. I don't know if they've declared bankruptcy, but they've got to be on the brink.
There's so many of them.
Another one, GameStop. I thought GameStop was going to go bankruptcy. I thought they were going to go bankrupt like 10 years ago. I mean, nobody buys those games in store anymore. They're always buying online.
And all these names remind me of Radio Shack.
Yeah.
Right?
Yeah.
Radio Shack. So
they won't be around much longer.
Another one, Seth, and I wanted to hear your thoughts on the high-end brands. They seem to be weathering the storm pretty well, but I think of Capri Holdings, and I'm sure you know them. They're the owners of Michael Kors, Jimmy Choo, and Versace. It seems like the high-end stores are doing pretty well, but those like middle brands that aren't quite the Louis Vuitton, that type of level,
Gap.
yeah, it feels like those type of brands aren't going to survive this. Am I in the right thinking here, Seth, or do you think they'll be fine?
Well, I think there might be a little bit of distortion because what you're talking about is luxury brands, and those are going to be tied to Chinese consumer spending, which is earlier in the cycle in terms of bouncing back. So if you were looking, to invest money right now, Chinese consumer, a lot of the Chinese macroeconomic data is a lot better. They've probably handled the COVID stuff a lot better. It's more opened up and the spending's returning. So I don't know that I would. You got to give me more info on the medium brands, but I don't know because that's kind of a wide swath. But
Sure.
My first intuition was that a lot of those are doing better because the Chinese high income sort of luxury spender is returning.
Okay, fair enough. All right, so let's talk about inflation or deflation. This is something, Kevin. This is your topic for the day, so I'm going to let you take the reins after I give a little bit of background here. And I think it's a good topic to talk about because Jerome Powell is set to give a virtual press conference from Jackson Hole on Thursday, in which people are expecting him to give a kind of an overhaul on the Fed's. The Fed's outlook on inflation.
Mm-hmm.
People are expecting him that they're going to say that they're going to allow inflation to run and even and look to let inflation run above that average target of 2%, which makes sense. It's been running under 2% for every year but 2 since the financial crisis. I think it'll be fun if we made a little drinking game out of his speech. I think we're going to hear the words average inflation at least a dozen times. But we'll watch this. They're trying to avoid that Japanification idea.
Mm-hmm.
It happens often. The economy slows. People hold back money. They hold back on purchases, hoping for lower prices. That deflationary period. Kevin, go ahead and give us the thoughts about entering a deflationary period because investors are split right now.
It's a hot topic. You have all of this flood of liquidity hitting the system, and everyone's running around saying inflation, inflation, inflation. But there's one more stop that money needs to take on the road, and that is for banks to actually lend it out, and that's where money creation really happens and hits the actual economy. It's almost like the liquidity. If I had a counterfeiting press in my garage, which I don't, Andrew, I don't. But if I had that, I could print $1 trillion worth of cash, and if I just left it in the garage, it's
only
not
because you don't have a
inflationary.
garage. You're keeping it in the. It's only because you don't have a garage right now. You're keeping it somewhere.
I'm keeping it somewhere else. But if I just kept that $1 trillion in a garage, it's not inflationary whatsoever. Now, once I take it out and start spending it, then it becomes highly inflationary. So it's really the appetite for credit and consumer credit and that power. So that's the real key and flux to it. And some people call it, between the money supply and the velocity of money.
Yes, velocity.
And velocity, yeah. So, and spending it is the velocity of money. So I think that I think we've trended this way since the Great Recession. I think this is another bump in the road on a really a deflationary environment and what you might call a Japanification of the world economy, and the U.S. being part of that because of debt levels and also demographic changes.
Seth, you got any thoughts on Kevin's deflationary environment idea, or you think we're headed towards inflation like the rest of the market?
Yeah, well, Kevin's a gold bug, so
I am an Austrian.
I'm not. I know he doesn't expect Goldilocks inflation. He either thinks we're having massive deflation or massive inflation. I'd say a couple things on that. So I think if you think about the situation geopolitically, you basically have China and the U.S. going head to head for staying or becoming number one in the world. And so I think as the U.S., one of your biggest fears to going down that path is that you get stuck in a Japan-style deflation. And there's a very well-defined template for that because it's been going on since the stock market crashed in 1989 in Japan. And so, there's a lot of interesting angles there. They got to be careful because given the fact I think we have 26 trillion in debt, every 1%, in interest rates in the 10-year, it adds up to billions and billions and billions of dollars in interest expense. So that's kind of a fine line, and you don't want to get back to the Volcker days where we had double-digit inflation. The other thing I would say, just from an investment perspective, which I think is intriguing and interesting, is, a lot of people call Jerome Powell PE Powell because he worked in private equity. It's going to be bad for private equity because if you get a lot of inflation, interest rates are going to move up. That's going to make leverage more expensive. And not only that, but from an investment perspective, you might see a regime change. I already think you're going to see this because as the world opens up and we get a vaccine or tame this thing down, the economy should grow again, which favors value and cyclicals over growth stocks. And then as interest rates go up, that'll dent the growth stocks valuations in a DCF. But it has all sorts of implications. It's also a weak dollar policy, which will favor emerging market investments, oil, things like that. So it kind of gets my mind spinning. But it is interesting that we've had below 2% inflation for like a decade, right? So obviously, I look forward to seeing what he has to say.
So on that note, as you said, inflation's been under 2% basically every year except for 2 since the global financial crisis. Do you think, let's say that Powell does come out tomorrow or does come out Thursday and say that the Fed will be focused on running inflation above their target? We don't know that for sure, but we think it will. Do you think it's necessary?
I don't know if it's necessary. I don't know if they can actually do it. I mean, they can model it, right? But unless, money is created when people, you can print money, of course, but it's all in debt. 75-80% of all the currency, US dollar, of course, is debt. So unless people want to take on debt and, start that process of money velocity, there is no inflation. So I don't know how much the Fed really has control of it.
What do you think, Seth? Is this necessary? You just said that inflation's been running low for a long time. Do you think it's necessary for them to focus on running it above 2%?
Kevin's referring to pushing on a string, by the way, as the term.
Yes.
I will say this. I don't think that they should raise interest rates anytime soon. So I'm sort of on board with that camp. I think, and obviously, the traditional arguments, when I look at my cost of healthcare and housing and what else am I missing? There's one other thing that I'm blanking on right now, but there's one huge cost that's also running up, education. That may come down due to COVID because a lot of that's going to move online, which is inherently deflationary because tech disruptors tend to be deflationary in nature. So, but those last two, I think you got to be careful, but I think that deflation is the worst outcome. And we know from the Great Depression in Japan that takes you decades to get out of. So I do kind of understand where they're coming from.
Yeah, I guess I'm somewhere in between you two. I think that I don't think it's completely necessary now, but I'm also with Seth in the not raising interest rates anytime soon boat. But if we look at service side, where up until COVID, the U.S. spend the majority of their money, service side inflation is not going anywhere. Their biggest input is labor. We've got 30 million people on unemployment benefits. We're not going to see any upward wage inflation anytime soon. It's going to take a long time to work through that glut of people unemployed right now. So I don't see that becoming a big deal, really. So I'm actually in the case that I'm excited to see what Powell says, but I'm in the case that doing nothing right now might be the best plan, but we'll keep up with that. We'll talk about it again on Thursday. We'll see where that goes. But we've only got about a minute here. Let's ask my time to kill question for you, Seth. OTRI now sits at 24.7. This is our outbound tender rejection index. It needs to climb another 3 or 4 points to cross over that 2018 all-time high. Do you think we do it?
No, I'm going to go under.
How about you?
I'm going to go under 2. I think it's a natural bound, and that's where we're at.
Yeah, I agree. I think we are reaching that point. I don't think we go much higher from here. We keep seeing little blips where it falls down for a few days and then rallies a little bit higher. I think we eventually hit our peak here and kind of fall down.
And even if it stayed at 23, 24, 25% for a long period of time, I mean, that's
carrier's delight.
It's booming, yeah.
By the way, just a update to a long short that we did. I think 3 weeks ago, we talked about will the S&P cross over into all-time highs, but before the end of the year, it did. We also did long short whether it would stay there. That's to be foreseen, but we have hit all-time highs on the S&P, so I wanted to give you all an update on that. Next week, we're going to be continuing our conversation with Ben Gordon. He's going to come back on. We're going to talk about SPAC some more. We're going to talk about Amazon acquisition rumors. We heard about AMC. We heard about companies all over the world. So we're going to be enjoying that next. That'll be next Wednesday with Ben Gordon, but thank you all for enjoying this, and we will see you next week, everyone. Have a great rest of your week. Thanks.